Hello and welcome. My name is Jason Martin from AllGen Financial Advisors. Today is October 5th, 2021. We're going to give everyone an update on some of the recent market volatility. Also look at kind of how we're navigating that, some of the portfolio positioning, and then touch on dollar cost averaging during volatile times. So let's hop right in. So kind of where we think this volatility is coming from, kind of the main reasons for it are a few different reasons. So one is right now there's a lot of negotiations going on in Congress about the $3.5 trillion stimulus package and also raising the debt ceiling. Okay, and the U.S., the way it works is we have a debt ceiling in place. We can't borrow anymore once we get up towards that debt ceiling, which is where we're at right now. And in order for us to continue to run the country, we have to, currently because we run a deficit, we have to increase the debt ceiling. And so right now we're having an impasse of negotiations between raising the debt ceiling and potentially adjusting the stimulus package. So that is, the fear with that is that, what happens if we don't raise the debt ceiling? Are we going to default? Is it going to cause the economy to go down? That's the concern there. Then also at the same time, well, even tied into that a little bit is some of the fiscal policy uncertainty, the fiscal being the portion where, what kind of stimulus comes out from, the stimulus package that I was just talking about. And at the same time, from a monetary policy standpoint, the Fed already mentioned in their last update that come November of this year, November 2021, that they were looking to start to taper. And what that means is they're going to slow down the quantitative easing, basically, or effectively slowing down stimulus. And that we think is kind of the bigger concern long term, or as we kind of go into the end of 2021 into 2022, is will the market be able to run on its own without having that stimulus? And so while that hasn't happened yet, markets usually kind of make their adjustments prior to it happening. But we believe that is kind of the bigger long-term thing to see if can the market run on its own or not. Now, the other one that's hitting a lot of headlines is inflation fears and global supply chain bottlenecks. So from that standpoint, we think that's more temporary. If you kind of rewind, what caused a lot of the inflation is that you had a lot of stimulus, right? A lot of quantitative easing, a lot of stimulus checks going to people, not just in the U.S., but globally. And so you have that's demand to purchase products and services. But at the same time, you had supply chain bottlenecks from less supply, which means, there wasn't as many people. There's a lot of people that were furloughed. There were a lot of layoffs. And just a lot of lockdowns where people couldn't go to work. So you couldn't manufacture products, and the supplies for those products were being reduced. So that caused less supply. So when you have higher demand and less supply, that causes prices to go up. Simple economics. Now we're kind of going into a time period where we believe that's starting to reverse. Less demand from less stimulus, and because prices are already gotten pretty high, and at the same time increased supply, where now people are starting to go back to work after a lot of the furloughs, after a lot of shutdowns, after the vaccine's been out for a while and people are vaccinated. So we believe that as kind of coronavirus is starting to subside, and those numbers are showing right now, both especially deaths have decreased, but also cases as well, both here in the U.S. and especially in some emerging markets. So we believe some of these global supply chain bottlenecks will start to reduce. So we believe the inflation is more of a temporary thing that will start to get better in the next few months. And then the last kind of big headline was China's Evergrande, which is a publicly traded company in China that holds a lot of debt that is running into a problem where they're not able to pay their debts. And so they're having to go through some negotiations, potentially selling off parts of their companies or some of their asset, and that's caused some concern. So let's kind of look a little at a time period back from 2011 where it was very similar till now. I remember kind of 2011 where you had both 2011 and now you had basically an impasse of negotiations of raising the debt ceiling, just like now, and you also had a reduction of quantitative easing, which we had then in 2011. We're starting to have that now. But you can see here in 2011, the markets from the top to the bottom dropped 16%. As of right now, we're down about 5%. Okay. Now, to put that into perspective, if we look here at about a 14, 15-year chart going back to 2007, this was the 2011 near default with the same kind of situation where we're trying to pass the debt ceiling, a bill to raise the debt ceiling. That finally did happen. And then the markets eventually rebounded and had a nice strong rebound afterwards. But during that time, those headlines were very strong, and there was a lot of fear in the market. And then we're not quite at that same level, but right now, a little bit of fear in the market. Markets have dropped recently, not nearly as much as over here. But I pointed out here on a bigger chart just to kind of put things in perspective. A lot of times when we zoom in on a certain situation, like if the last chart we were zoomed in on that 2011 drop and that current drop, they seem like really big deals. But when you kind of zoom out and keep things in perspective from a long-term time frame, you can see that the market is pretty resilient and it continues to go up over time, even after some significant drops. So we don't know how this current drop will end. But we do believe that over time, markets do continue to appreciate over the long run. So I point out this particular chart because, if we started to get defensive, and I'll talk a little bit about that on the next slide, but as we were kind of going into this September and October timeframe that we're in right now, and one of the reasons we started going defensive is because during that time, period, that 2-month time period from September to October, that is the weakest 2-month time period of the year. And as we look here from 1900 to 2020, kind of 120 years of history, you can see that less than half the time the market was up during that time, and on average it was down about 0.7%. Now, as we're kind of early October, and as we kind of start to end October, we will be going into one of the strongest time periods of the year where the market's up 72% of the time, and at the same time it has the largest returns of any other 2-month time period. I point that out to show you that seasonally we're in the weakest part, but we're towards the end of the weakest part of the year, and we're going into what we believe, or not what we believe, but historically has been the strongest time period of the year. And I point all that out to say, late July, early September, we sold out of our gold in our portfolio, and we increased bonds as a defensive posture and added a small amount to emerging markets, as emerging markets had dropped quite a bit before that. And then, the increasing the bonds was a move that we put in place, was actually a temporary move to protect for a market downturn. Now the market's going down, and our thought process is we're looking to eventually sell those bonds, a portion of the bonds, and then buy into stocks at a time period where stocks look attractive. I'm not sure if we're there yet. We will continue to monitor to see, if this is towards the bottom. Obviously, no one knows the future, but we're going to try to find an opportunity where we think the markets are about to turn and go back higher, and we'll look to get out of our defensive posture and be opportunistic during that time. So that's kind of the thought process as we go into these next few weeks to see how things play out and look for an opportunity to take advantage of stocks that are potentially lower. Now, I'm going to end this presentation with kind of one slide that comes out of our e-course called AllGen Academy. And in that course, we talk about dollar cost averaging. But dollar cost averaging in general, just going to give you a quick update or a quick kind of idea of what it is. It's basically when you take an equal dollar amount and you invest that periodically over time. So let's say you invested $500 every single month. And so equal dollar amount over a periodic period of time. And the benefits of doing that, I'm going to show you in these two charts. So this first chart is no dollar cost averaging. And if we're looking here at a period of September 5th of 2000 all the way to November of 2011. During that time period, the S&P 500 of the market represented by this red line, was essentially flat. You went through two big drops, the 2000 to 2002 drop, and you also went through the 2008 financial crisis, and then two bull markets as well. But from point to point, the market was flat. And $100,000 invested with no dollar cost averaging at the beginning, you would have had zero returns, basically a flat market. You would have invested 100,000 and ended near 100,000 towards the end. Now, same time period with dollar cost averaging, and you can continue to contribute through thick and thin, through the market going down and coming back up. You can see here that you actually had a 3% return. Investing the same exact dollar amount, investing $100,000, a little over $100,000 during that same time period, you had a return of 3%. Now you're saying, Jason, 3% is not a very big return, but that's 3% on average every year during a time period where the market had a 0% return. So that's beating the market by 3%. Consistently over time. That's a very significant thing. And it's all done just through a simple technique of dollar cost averaging. And I point all that out to say, if you are working and you're accumulating and you're trying to save and invest, you don't ever want to use a market drop to scare you out of stopping your contributions to your 401k or stopping your contributions to your investments. A market drop, if you're doing dollar cost averaging, is actually kind of what you want, because with the same dollar amount, you're buying more shares as prices go lower. So, it's just a simple strategy, very effective over time. Would encourage you, if you're in that contribution mode, that accumulation mode, to continue, or if you're not investing, and you're in a position to, meaning, you have a strong foundation, as we talk about in AllGen Academy, or just how we talk about here as advisors. If you have a good amount of emergency reserves and you also have no consumer debt, you're in a position where you have a strong foundation and you can invest over time. And the dollar cost averaging technique is a great, simple way to build wealth over time. If you wanted to see more about our AllGen Academy, if you go to our homepage, allgenfinancial.com, and then just click on this down arrow right here under accounts and go to AllGen Academy, you can see both of our courses, which is our foundation course and our formation course. The foundation course is free for everyone, and then with the newly released formation course is free for clients. So just encouraging you to learn. We believe that we should all try our best to kind of build wealth and be good stewards over time. And those are great courses that teach you a lot of fundamental things of how to build wealth over time. So all I have to say, I hope this helps. If you have any questions, please reach out to us, and we'd love to walk you through that. Take care.